Hello, fellow investors. I'm Ben, and this is GVD Investing, where I break down the latest stock market news, analyze stocks, and share my personal investment journey in hopes of making us all better investors. If you're watching this video, thank you for tuning in to the very first video on the channel. If you like what you see and want to see more videos from me in the future, please like and subscribe to help the channel grow. Let's get to it. What a year 2020 has been. For anyone who's been investing this year, you'll know exactly what I'm talking about. We had the fastest crash the market has ever seen back in early March, followed by the quickest recovery the market has ever seen a few weeks later. Since then, people have been buying stocks like toilet paper, and FOMO has been spreading faster than the virus. You would think with millions unemployed, businesses locked down, and widespread economic uncertainty that the markets would have struggled in 2020, but in fact, the opposite has taken place. Back in March, the TSX fell from 17,000 to under 12,000, but in less than 9 months has since erased those losses, breaking all-time highs, up 3.5% over the last year. The S&P's had an even crazier year. It fell 30% in March to under $2,300, but has since rebounded over 60% to $3,700, breaking all-time highs, and is now up almost 17% over the last 12 months. It's truly mind-blowing how fast the major indexes have recovered this year. The Dow got absolutely hammered, falling 10,000 points in March from 28,500 all the way down to 18,500 before exploding throughout the summer and breaking all-time highs in November, hitting 30,000 for the first time. And how could we forget about the almighty NASDAQ, the index that's home to the titans of tech, the conquerors of capitalism? Tesla, Facebook, Google, Amazon, Microsoft, Apple, these companies have all been in beast mode in 2020. With business models capable of succeeding under almost any conditions, including a once-in-a-100-year event, these companies have actually benefited from the pandemic and continue to grow rapidly, seemingly unfazed by the economic destruction countless companies are facing. So let's take a look at the stock charts here. Facebook fell over 30% back in March, and then since then has actually gone up almost 90% in the last 9 months. Taking a look at Google, it had an even faster fall. It fell from around 1,500, it fell about 30%, all the way down to around 1,000. And then since those lows back in March, has popped about 70%. Amazon, it didn't get hit as hard back in March, but still fell pretty good. It fell about 22%. Since then has come back 85%. Moving on to Apple, they fell 30% back in March, and then don't forget they had a split this year. I think it was towards the end of August anyway, and then since then they've actually kind of flatlined a little bit, but this year they've gone up 112%. Microsoft is no different. They also fell about 30% back in March, and it's been almost uphill ever since. I haven't risen as fast as some of the other companies, but since those lows back in March are up, 55% so far this year. Considering how fast they fell and how quickly they rebounded, it's pretty insane to look at these stock charts. And while we're speaking of insanity, how could we not talk about Tesla, the king of all FOMO stocks for millennials? It fell in March hard. It fell about 60% when the lockdowns first started, got absolutely hammered. But since then, in less than 9 months, they've gone up 745%. If they keep at it, they'll be at almost 100% a month, which is quite the return for a stock, and has led to market conditions that I don't think anyone really predicted throughout this year, and an EV market that is just absolutely taking off. The question is whether it's justified or not. There have been so many companies that have burst onto the scene this year through SPACs and IPOs, it's been honestly hard to keep up. There's been Hyln, Neo, Lordstown, nkla, Workhorse, Fisker, doesn't even really get into Blink and ChargePoint, Canoe, Arrival. At this point, all you have to do is say you're going to build an EV and your stock will absolutely skyrocket. Speaking of saying you're going to build something, I guess it's time we talk about nkla, the company with revolutionary battery technology that was supposed to compete with Tesla.
Is a fully functioning vehicle. It's not just a pusher. It's not just a pusher.
Yet, as we come to learn, none of those claims turned out to be true. Allegedly. In the summer, when Nikola's SPAC merger went through, Tesla was at the peak hype prior to their August split. So, as a result, hype around Nikola started to grow. And man, did I fall victim to this hype. I bought it hook, line, and sinker. It turns out it's easy to be fooled by fancy YouTube videos and investor presentations. Now, let me explain myself before I lose all semblance of credibility. See, I just started investing this year in January, so I'm a relatively new investor. And for most of that time, Tesla stock had been running like crazy. I didn't want to buy it at such crazy valuations, so I started to look elsewhere for stocks to buy. Keep in mind that at the time, most of these other SPAC mergers hadn't gone through yet, so there wasn't very many options for exposure to the EV or hydrogen market. So in late August, I decided to put $1,100 Canadian into Nikola. I think it was 2 days before they merged with GM, which at the time seemed like a great deal, for about 24 hours, until the Hindenburg short report and details of the deal actually started to come out. I won't go too far into the details because for most investors, they already know what happened. But for those who don't, the gist of the short report was that today we reveal why we believe Nikola is an intricate fraud built on dozens of lies over the course of its founder and executive chairman, Trevor Milton's career. We have gathered extensive evidence, including recorded phone calls, text messages, private emails, and behind-the-scenes photographs detailing dozens of false statements by Nikola founder Trevor Milton. We have never seen this level of deception at a public company, especially of this size. Needless to say, this was not good news. And to make matters even worse, agreeing to the deal with GM seemed to actually verify the allegations against them made by the Hindenburg report. See, by agreeing to the deal, it made it very clear that Nikola didn't actually have any revolutionary battery technology, manufacturing, or engineering. GM would be doing all of it. So, after reading through the whole Hindenburg report, going through the GM deal in detail, I decided it was time to sell my shares in Nikola. Sometimes it's better to just cut your losses and move on. Fortunately, by making this decision quickly, I ended up only losing about $100. Had I held on to those shares, I'd be down over 50% in my position now. Since then, GM has actually pumped the brakes on the deal with troubled electric startup Nikola. GM Motors ditched its plans to acquire an equity stake in troubled electric startup Nikola. GM will also no longer help engineer and manufacture Nikola's battery electric and hydrogen fuel cells, including the Badger pickup truck. It won't come as a total shock to anyone who's been following Nikola over the last several months. Less than a week after GM announced its plans to acquire an 11% stake in the Buzzy company, short-selling firm Hindenburg Research published a bombshell report accusing Nikola of fraud and showcasing its electric vehicle technology. Nikola founder Trevor Milton stepped down as board chairman on September 21st in the wake of the report. On Monday, I think this was, November 30th, the two companies announced a much diminished agreement that retains the fuel cell partnership. The previous agreements, which included a stock component, were all terminated, a GM spokesperson said in an email. So, at the very least, my brief time as a shareholder in Nikola taught me a very good lesson on how to do proper due diligence into stocks and not to blindly believe the hype you see online regarding certain companies. After this experience in Nikola, I actually went through all of the stocks in my portfolio and ended up selling all of the ones that I didn't really believe in and that the numbers didn't really add up, except for one. They kind of hung on the edges there, and I think you guys probably have heard of it, Workhorse, which is the real reason I'm actually making this video. Since the midsummer, there has been a ton of hype around Workhorse and the potential for the massive USPS contract to go through. So in this next part, we'll take a look at the current state of the EV market and do a quick comparison of some of the most hyped EV stocks right now. Then I'll break down the 8 major red flags I've identified in Workhorse, what I'm going to do with my position or have done with my position, and lastly, what does the future hold for Workhorse stock, the state of the USPS contract, and try to understand what ARK Invest sees that I'm missing. So let's take a look through some of these EV stock charts. We've got Workhorse here. We've got quite the year for Workhorse. They sat at basically between $3 and $1.50 for most of the year. And then in late June, they jumped 750% over the course of a few weeks or a month. And since then, they really haven't done a whole lot. In the last few months, they've only gone up 4%. So unless you got in and caught that huge ride up, there hasn't been a lot of movement in Workhorse, even though it looks like it. It's kind of flown up and then flown down and then flown up and flown back down. But at the end of the day, it's kind of ended up being basically where it was back on early July. Even though overall things have been pretty flat for Workhorse since July, they have had a few pretty crazy swings. This one here, they jumped 100% over the course of about a month from mid-August to mid-September, and then proceeded to give those gains right back and fell 50% over the course of 9 days in late September. Then jumped up again, another 90%, and then gave those gains right back and falling another, well, not all the way back, most of the way back, another 25% to where they are now, sitting at about $22. So as you can see, Workhorse has been extremely volatile for most of this year, and it gets actually more apparent if you go to the max. They really haven't done much for the last 5 years. They had a little bit of a burst here in 2016, 2017, then did absolutely nothing from 2017 to mid-2020, and then they jumped almost 2,000% in 6 months. So I think Workhorse is a very exciting company, but I really don't think their performance of their stock being up over 2,000% in the last 6 months, which is over double Tesla, is warranted given where they are as a company at this point. We'll get more into that in a second. But first, let's take a look at some of these other EV stock charts. Okay, jumping over to NIO now. It's been another wild year for them too. The whole EV market has just gone absolutely insane this year. There's been a bit of a pullback in the last couple of weeks, but still, a lot of them, almost all of them really. Some justified, some not justified. NIO, I would say, is a little bit more justified than some of the other ones, considering it's one of the bigger players, if not the biggest player in China, which is obviously one of the bigger markets on the planet, if not the biggest EV market on the planet, especially over the next decade or two. But yeah, they're up like 1,000% this year, even after the pullback. So at one point they were up close to 1,400%, or maybe even 1,400%. And it's been a much more consistent ride for NIO than it was for Workhorse this year. Their production's a lot better. It is a Chinese company, so there are some risks involved with that. Like there's a chance they might get delisted coming up, but I don't think that's likely to happen. The question is whether they can stay in this crazy stock ride, because like if you zoom out here to a longer term, all of these EV companies really didn't do a lot. I guess Tesla really didn't either, but riding the coattails of Tesla this year, all of these companies have just shot up like mad, and we'll go through the numbers in a sec, but I guess you kind of see where I'm going with all these stock charts. It's just been an absolutely insane year. Let's take a look at XPeng stock. This stock's only been listed since August. Even in that time, they've jumped from 80 cents. They jumped 90,000%. Yeah, I said that right. 90,000% in under 3 months. From September 1st to November 23rd, they jumped 90,000%, which is, for a new company with almost no track record, is, I don't know if ridiculous is the right word, but 90,000% in 3 months. I don't think that's sustainable. I guess we'll see what happens with this one, but they've fallen 35% since November 23rd. So we'll see how much of this is just hype. It's starting to look a lot like the cannabis bubble in 2017, 2018. These stocks are just rising so fast that I guess invest in them if you want. Enjoy the volatility, but for most of these companies, I'm just going to stay away. Heck, it'd be fun to be in for that, but need to see how these numbers play out over the next little while before significantly or seriously investing in most of these EV companies. If you're a trader, go for it. I think there's clearly there's a lot of money to be made in some of these stocks, but there's also a lot of money to be lost in these stocks. So unless you know what you're doing, you really need to be careful. So moving on, we'll take a look at Lordstown Motors. They're actually an interesting company, but their stock has really not done very well lately. Workhorse owns 10% of Lordstown, but Lordstown, they took over GM's old manufacturing plant in Lordstown, Ohio, hence the name. They've agreed to do some of the manufacturing or most of the manufacturing for Workhorse if Workhorse ends up securing some or all of the USPS contract. Lordstown's also got a truck that was unveiled at the White House recently in late September, and I think they're going to be the first to market with a pickup truck before the Cybertruck from Tesla. And I own a landscape company, so for a company vehicle, Lordstown might actually be a better work truck than Tesla would be. That obviously remains to be seen, but the Cybertruck looks more like a personal truck than a work truck, I would say. The specs of the Cybertruck are really good. I don't know if I could see myself landscaping in that thing every day. Whereas Lordstown's truck is really nice and seems to be viable for commercial applications too. So pretty cool pickup truck. It'll be interesting to see where this company goes over the next few years, but a crazy year for the stock, really. It spiked hard at the end of July, beginning of August, jumped up 200%, and then fell drastically from there, almost gave it all back, dropping well over 50%, and then jumped again. Not back to the all-time highs, but pretty close, another 120% jump. And then have since then, currently we're in the midst of a pretty big dip with Lordstown. I don't actually own any Lordstown shares, but possibly down the road I would be interested in getting into this company. Still a little bit early on. They've only been traded for the last couple months. I'd like to see a little bit more from this company before I'd be willing to invest, but they're interesting and definitely promising. They have cool product, and Americans love pickup trucks. So if they can make this work, they have the production, they have the assembly plant, they have a cool truck, and I guess we'll see now if it sells over the next few years. In the meantime, I'm just going to sit on the sidelines and watch the volatility in this one until the truck hits the road and they have a bit of proof of concept, see how that turns out, some numbers to look at. Then I definitely consider investing in Lordstown down the road. And lastly, let's take a quick look at hyln stock here before we do some number crunching. This one has been all over the place. I don't even know where to start with this one. I guess they kind of jumped from somewhere down here. What was this? 423% up at one point. But then look at that fall. It dropped 90% in 2 days. So that's the volatility of EV stocks right there. You can lose all of your money basically in 3 days if you're not careful. I mean, you're really going to have to watch out in these ones unless you are a skilled investor or have giant cojones and are willing to sit and watch your money drop by 90% in 3 days. So that would have been hard to handle, that one. They're a hybrid truck company that looks to make hybrid truck chassis for aftermarket trucks, transport trucks. I honestly don't know how well this is going to work, and I think the stock kind of represents people's uncertainty as well. I don't know if truck companies will be willing to pay to outfit trucks with a hybrid solution when they're probably going to have to switch to an EV solution in relatively short order. It might not be right away, but pretty soon. And as a big truck company, that's a lot of money. I think it probably makes more sense as a business just to switch directly to EV and learn how to make that work. Maybe not. Maybe I'm not a transport truck driver, so I can't comment on it, but I know truckers are typically not looking to blow a bunch of money on stuff, especially temporary solutions. So it'll be interesting to see what happens with this one. I don't know, their stock is pretty hard to analyze. It's absolutely all over the place. It goes up, it goes down, like literally over here. I don't even know how that's even possible. Just like a kangaroo stock, basically. As a long-term investment, it might pan out if the idea takes off, but I don't even know if that'll really work because it's more of a temporary solution. So long-term, I don't know if it's even a great investment. It's kind of a mid-term investment where you're hoping that it'll take off for the next few years before they crash a bit, but I wouldn't be putting too much money into hyln. I know some investors love this stock, but I think I'm going to have to hold off on this one for sure. I definitely don't feel the excitement that other people are feeling in this one. It's a little too volatile for me. So I like growth stocks, but this one I'm going to have to stay away from for now. Now it's time for us to crunch the numbers. With everything going on in the EV market these days, Workhorse getting the delayed USPS contract, Tesla getting included in the S&P, NIO's on the rise, and business seems to be going relatively well for them. XPeng's even doing relatively well, but then companies like Lordstown and hyln, their stocks have been hit pretty hard and they still don't have any revenues. So it's kind of hard to go too far into their numbers, but I threw them on here just as a comparison. And then I even added on some just other growth stocks so we could take a look at how the EV stocks are comparing to other growth stock sectors. You can't really compare one industry to another, but just gives you an idea of how other growth stocks are doing. It was when I put this spreadsheet together that a few things about Workhorse really started to stand out to me. I know that on YouTube, a lot of people tend to focus on the stock charts, the candlestick charts. I actually haven't really seen anybody break down the numbers behind Workhorse. After writing everything down here, most of the stuff is relatively the same. Revenues are growing for most of these companies. No one's really suffering terribly from debt at this point, it doesn't look like. The main thing that stood out to me right away was Workhorse's price to sales is 3,500, which at first I thought that was a typo, and I double checked it. It isn't. Like in comparison to these other stocks, Tesla's price to sales is 21, NIO's is 26, XPeng's is 38, Shopify, which has exploded this year, is at 52, Zoom, which has also exploded this year, is at 57, Palantir, which is another hot YouTube stock, is at 51. Snowflake, which had, I think, the hottest IPO ever in history, is at 190 price to sales, which is absolutely ridiculous. But compared to Workhorse, I mean, Workhorse is an exciting company. The USPS contract is quite exciting, but I really don't know if they justify a price to sales that high, especially with a company that has more debt than cash, really only one product, and limited customer base, really, at this point. The price of sales is a major red flag here. Another major red flag with Workhorse that I noticed that really none of these other EV companies are suffering from is in 2016 they made $5 million in sales. 2017 they made $10 million in sales. And then I'm not sure what happened, but sales fell 90%, over 90%, from 10 million to under a million at 763,000, which is a massive fall in revenue. As a business owner myself, I don't know how you allow revenues to fall 90%, or for that matter, even stay in business after revenues have fallen 90%. And then for revenues to have fallen that hard, and then again 50% the following year, before coming back a bit this year to predicted 2 million, which is still just a fraction of what they made in 2017, to justify a price of sales of 3,500. Can you imagine these guys on Dragon's Den or Shark Tank trying to convince Kevin O'Leary that their company that only made $376,000 last year somehow justifies a $2.6 billion evaluation? I think Kevin O'Leary would laugh them out of the room. There's a lot of issues here with Workhorse. Okay, so I know this video has been a long one. Bear with me a little bit longer. We'll just recap the major red flags in Workhorse, and then I'll get this all wrapped up. So, as I said before, the biggest red flag to me off the bat was the insanely high PS ratio, the price to sales ratio of Workhorse. And for those who don't know what a price to sales ratio is, the price is the market cap, which is the value of the company right now, divided by the sales, the most current year's sales, which means right now they're trading at 3,500 times what they made last year. Or for another example, basically if you went to buy a chocolate bar that was $1, because of what the public view that chocolate bar as, it would be $3,500 for that $1 chocolate bar, which, I mean, you can pay $3,500 for a $1 chocolate bar if you want, but I'd just buy another chocolate bar. I don't need that specific chocolate bar that bad. The second major red flag was the 90% revenue decline from 2017 to 2018. That's a major red flag. The one thing you want with a growth company is sustained growth, and to have a 90% decline in revenue followed by a 50% decline in revenue is not what you want to see out of a growth company. At the same time, if you look at the cash burn, every year they've burnt multiple times more money than they've made. And especially the last 2 years when they have hardly made any revenue at all, they've still burnt extremely large amounts of cash. And even though revenue is back on the rise this year, they'll be lucky to hit $2 million if they do. And at $2 million, that's still only 20% of the revenue they were hitting in 2017. So that's a massive red flag that needs to be addressed by the company. Another red flag, this one not as serious, would be the debt situation. Currently have more debt than cash, which is never a good thing. It's not terrible. They've got $80 million in cash, $123 million in debt. So the big problem is when the revenues are declining, you're burning that much cash and you have that much debt, it's going to make it really hard to pay off those debts. So we'll see what happens with the USPS contract. But if that doesn't come through, Workhorse could be in a lot of trouble financially. The one option they do have would be to issue more shares to raise capital, but all that does is dilute shareholders, which at this point it wouldn't be the end of the world, but it's definitely not a good thing. So the debt could become an issue going forward if Workhorse isn't able to work that down. And part of working that down is securing the contract with USPS, which was delayed once again on December 2nd, and also showed just how reliant the stock is on the USPS contract. Without that contract, or any time the contract gets delayed, the stock absolutely plummets. Then it seems to rebound in between, and then the contract gets delayed and the stock plummets, and then it rebounds. it just continues on the same cycle over and over again. This time, the contract was delayed until Q2 2021 for the government, which is actually Q1 of next year, meaning that we should hear something by March. But given everything that's going on in the world, the election, the pandemic stuff, the lockdowns, the economy, really, when Biden takes office in January, it's unlikely that this will be top of mind. And even once the contract's decided, there's no details right now of what the contract would even entail. So basically, especially knowing the government, this could be another 5 years before production even starts on any of these vehicles. We don't know how much of the contract Workhorse might even get, the profit margins on any of those vehicles. There's so many questions when it comes to this contract, but the contract itself may not even prove to be that beneficial for Workhorse depending on how the contract is structured. Don't forget how things worked out for nkla after the deal with GM. Unfortunately, at this current time, I think the performance of the stock is too heavily reliant on the USPS contract that may or may not come through. So personally, it feels to me like if you're putting money into Workhorse at this point, that you're basically gambling on a USPS contract rather than investing in Workhorse as a company. Which brings us to the next red flag, Workhorse's potential scalability, which I see as a big problem, because if they land the contract to get 180,000 trucks built, even if it's not all at once, they currently do not have the manufacturing capabilities to produce 180,000 trucks. So they'd have to hire a massive workforce, which in business is one of the hardest things to do, is to grow a business successfully, add all new staff, and have everything go right. And their product is unproven. So not only do they have to hire all new staff, they have to build product and make sure that the quality is good enough to satisfy the USPS contract. And furthermore, the fact that they already had growth in the past from 5 to 10 million but weren't able to sustain that really makes me wonder how capable Workhorse is of scaling up the company. Which brings us to the next red flag, which is the lack of orders from other companies other than the USPS. Keep in mind, Workhorse is not a new company. They started business in 2007, so they've actually been around for a fair amount of time. It kind of worries me a little bit that companies like Amazon and Walmart aren't showing much interest. FedEx and even UPS haven't placed any orders. They do have a couple trucks they sold to Ryder, and I think they have a 500 truck order from Pritchard. I mean, that's not enough to sustain this business long term unless they get some major order from either the USPS contract, obviously, or something else like Amazon and Walmart. But they seem to be more interested in working with other companies, and even the drone technology that Workhorse has. Amazon has their own drone technology, so that could actually end up being a competition between them and Amazon going forward, which, given Workhorse's capital and Amazon's capital, I'd be putting my money on Amazon to win that race. Which leads us to our next red flag, which is the incoming competition. They're not alone in what they're doing here. So, I mean, Mercedes already has a huge contract with UPS, and they have been making last minute delivery or last mile delivery trucks for a long time. Ford also is starting to turn around and is putting a lot of money behind their electric delivery trucks. And even the new startup Arrival, they have some pretty interesting delivery trucks. So Workhorse won't be alone in this. There's other companies that might be able to capitalize on this. Then Workhorse is really going to be up against it unless they secure that contract. Which brings us to our last red flag, which is just Workhorse's overall poor track record as a company. If you look beyond the hype and the hope of them potentially landing the contract, the fundamentals of the business really aren't that great. The history isn't good. They're incapable of sustaining growth and scaling the business properly. They have more debt than cash. They haven't been profitable in 13 years as a company. They lack sales, manufacturing, and adequate staff if they do get the contract, and at this point are overly heavily reliant on the contract as a company. They set expectations of potentially hitting 500 vehicles this year. It sounds like they're only going to hit around 200, so they're not meeting expectations on the production side even without the contract, and have burned through $210 million in the last 2 quarters while only making $700,000 year to date. And finally, their one and only product is unproven, especially on a mass scale. So, after all of that, you're probably wondering where I think the stock will go over the next few months and what I decided to do with my position. I did decide to sell my position. I had a cost basis, which was 1988, which is kind of strange because that's the year I was born. But after the contract was delayed once again, and I put the spreadsheet together and went through all that stuff, I basically decided there was no way I could feel comfortable holding my investment in that company. So I decided to sell out half of the position at just under $21 and then the other half of the position just over $21. So I ended up with a slight profit, erased some of the losses from nkla, and then move the money back into some other companies that I'm more confident in, which we'll get into in another video. In terms of predicting where the stock price will go, it's extremely hard with these EV stocks. I would say it's highly unlikely, in my opinion, that the stock will break or test all-time highs until news from the USPS contract gets sorted out. I would say it's a lot more likely that it falls below 20 into somewhere into the mid-teens and kind of hovers there until the news comes out. I think basically everything hinges on that contract. So if they get the contract, the stock will skyrocket. If they don't, it could absolutely plummet. Let's take a look at a Zacks article and let them explain what they think will happen going forward and whether or not they think you should buy or sell. So here's the article by Zacks released on Yahoo Finance on December 2nd. Here's why a 23% plunge is not enough for Workhorse stock. EV stocks are gaining massive investors' attention amid heightening climate change concerns. But are all stocks in the space worth the hype and your money? Not really. The alarming concern is that many of the EV stocks have rallied far beyond a reasonable price, which has pushed their market values exuberantly. So far this year, the stock has skyrocketed 730%, making it highly overvalued. Considering the stock's weak fundamentals, any sharp pullback in the share price of Workhorse would not come as a surprise. Shares of Workhorse traded around 23% at the close of trading December 1st, as the USPS announced yet another delay to award its giant mail truck contract. The contract, which is likely to be split between multiple parties, would entail the manufacture of 180,000 delivery vans. After years of delay, the agency intended to award a $6 billion contract to upgrade its aging delivery fleet earlier this year. While the contract delay has triggered a pullback, there are plenty of reasons to be worried about this stock. They talk about the stretched balance sheet, no clear path to profitability. It's important for investors to note that the company is yet to turn an annual profit. Being in business since 2007, it's still struggling for profitability, with seemingly no strategic plan for a turnaround. The company's income is getting marred by mounting capex and SG&A as well as R&D costs. They've had a tough Q3 with dim prospects. They had a net loss of $84 million, widened 631% from a year ago level. Moreover, the company also warned that it may considerably fall short of the delivery target of 300 to 400 vehicles by 2020 end. They talk about the crazy price to sales ratio. And then finally, right here, their final thoughts on whether you should buy or sell or not. The general euphoria surrounding EV stocks has indeed resulted in meteoric gains in the share price of Workhorse. However, a stock cannot just endlessly run on hype. It eventually goes into correction to reflect its true fundamentals. Workhorse seems quite a speculative stock, with not much fundamental strength and a lack of sustainable business model. Hence, it would be prudent for investors to steer clear of the stock at the moment. Workhorse currently carries a Zacks rank number 5 or strong sell. That article definitely sums it up pretty well. I don't know if there's much else I really need to say about Workhorse at this point. For me, the fundamentals are just too flawed that I don't really see this as a sound investment. There's just too many red flags that outweigh the potential upside in this company. It's mostly just ifs at this point. If they can get the contract, if they can produce the vehicles, if they can turn a profit, if they can sustain the growth, if they can get the proper staff, if they can meet quality standards. It's just too iffy of an investment for me to put my money behind. I know ARK Invest loves this stock, so there's a good chance I could be wrong. They definitely have a great track record of picking good stocks and good companies, but keep in mind they have a much larger risk tolerance and a lot more capital to work with than smaller investors like myself and some of the people watching on this channel. If they lose millions of dollars on a small investment in their portfolio, it's not the end of the world for them. So if you are looking to open a position in Workhorse at this point, I would just be careful. I wouldn't make it a big position in my portfolio at all. Just keep it relatively small until there's more clarity regarding the USPS contract. And I wouldn't be buying anywhere above the $20 range. Ideally, the mid-teens, if it does fall back to the low teens. then that might be a good point to start a position. But that's why it's very important for you to do your own due diligence and form your own opinion surrounding Workhorse before making an investment in the company or not. But before you put any money into Workhorse, just remember these three things. Workhorse's price to sales ratio is 3,425.92. That's higher than the PS ratio of 99.73% of US stocks. Second, with a year-over-year growth in debt of 675.01%, Workhorse Group's debt growth rate surpasses 97.15% of other US stocks. And lastly, in terms of volatility in its share price, Workhorse is more volatile than 97.38% of other US stocks. Needless to say, be very careful. In terms of investing in other EV companies, Tesla is already my largest holding in my portfolio, so I'm pretty happy with my exposure to the EV market. Lordstown also interests me, but I'm more likely going to wait and see what happens with the release of their truck in late 2021. And if that rolls out successfully, then I would potentially invest in Lordstown. And I'm definitely interested in investing in NIO if this pullback continues. I find them very intriguing going forward. I like the battery swap thing that they have for their vehicles rather than having to charge them. China is the world's largest potential EV market. There's going to be companies that eventually compete with Tesla in some aspects, so I would definitely consider opening up a position in NIO. So I think that's a wrap, ladies and gents. If you've made it this far, thank you so much for sticking with me this whole time. I know it's been a really long video. The videos in the future probably won't be this long, but if you've made it this far, please tickle that like button. And if you want to follow the journey and be notified of future videos, please smush that subscribe button. Thank you very much. Until next time, be safe, wear a mask, and invest wisely.